Hello, good morning, everyone. Welcome to all of you for today's session. Thank you for your patience. You people had to wait a bit for me today. Just let me know whether you people can hear me well. Can you hear me well? All right. So in the last class, we have already started and discussed the corporate investment appraisal techniques we have discussed in the last session. And today itself, we will be moving towards the next area, which is the part of appraisal. So let me connect my iPad. Okay, we have to talk today about adjustments of adjustment in the investment appraisal. So this is the topic for today, which I remember from the last class. This is what we have to do today. We have discussed, the last topic discussed was IRR. So today we will be talking about, yes, I'm sharing my screen. Just a minute, please. Why it is not sharing it now? I hope it is visible to you now, my Excel sheet. Students, we have to talk about adjustments of inflation, adjustments in to the DCF, discounted cash flows. And you know that the cash flows are used in the various places. Cash flows are used in the various places. So adjustments. So what are the adjustments? First adjustment is that of inflation. Inflation. Then is that of taxation. Then is that of working capital. Then is that of risk and uncertainty. Then is capital rationing. So these are the topics now, one by one, we will be doing. So let us proceed further. Students, when we talk about inflation, what is inflation, by the way? Inflation is basically, so adjustment inflation. Inflation and DCF, discounted cash flows. Students, what is inflation? Inflation is increasing increasing price levels. That is called inflation. That is called inflation. Their prices are increasing. And inflation can be, when we talk about the inflation in your syllabus. So inflation is of two types. One is called specific inflation, and the other is called general inflation. Specific inflation, it is increase in the price of specific item. For example, we say rice price that is increased by 7%. For example, so that is the specific inflation of rice. Specific inflation of rice. We say wheat price that is increased by 9%. That is specific inflation of wheat. Petrol price increased by 3%, specific inflation of petrol. Salaries, cost of business increased by 10%, so 10% inflation. General inflation is calculated by the government, normally by the central bank. And that is basically inflation, which is weighted average inflation. It is weighted average inflation on various items, on a bucket of necessities of life. 6%, for example. So this is the average inflation in the economy. It is being experienced by a resident. So general inflation. So the point is how inflation affects discounted cash flows. How it affects. The effect of inflation is two sides. One side is impact on cash flows, and the second is impact on cost of capital or discount rate. Impact on cash flows and impact on DCF, cost of capital. Two sides, right? Now, when we talk about impact on cash flows, so cash flows are of two types. One, they are real cash flows. The second, there are nominal or money cash flows. So nominal or money cash flow, real cash flows. So real cash flows are which are without the impact of inflation. They are also called cash flows in today's term. They are also called cash flows in today's price terms. They're also called. Now, money cash flows or nominal cash flows, which includes the impact of inflation. Inflated cash flows, they are also called. They are also called inflated cash flows, already adjusted for the inflation. So impact on cost of capital. Cost of capital. That is again two types. One, real cost of capital, and the second is nominal or money cost of capital. Now, nominal, again, the same. Without impact of inflation. Without impact of inflation. And this is with inflation, which is inflated. For example, if we call it M, and for example, we call it R. R, for example. Now, students, there is a Fisher's formula. Fisher. Which tells the link between money cost of capital and real cost of capital. Fisher says that 1 plus M, if you want to calculate this money cost of capital, it is 1 plus R into 1 plus H, where H is equal to general inflation in the economy. H is equal to general inflation in the economy. H is equal to. Now, next. So, students, the next point is approaches to calculate NPV. Why we are studying it? Basically, that we have to calculate impact of inflation on NPV. Two approaches. One is called money approach. The other is called real approach. Money approach is that what we do, we inflate all cash flows with relevant specific inflation. Sales price is increased by inflation of selling sales. Variable cost by the specific inflation of variable cost. Same is for the money cost. For the fixed cost, specific inflation. So the point is, money cost of capital. Inflate all cash flows with that and get money cash flows. Now, step one. Step two, discount the money cash flows or nominal cash flows with money cost of capital and get NPV. Very simple, very easy. Real approach is that actually there are two cases. Case one. Real approach has two cases basically. Okay. The case one. The case one is that when specific inflations and general inflation is same. One same rate of inflation for all. It is quite rare you get in exam. Okay. I'm sorry. Then you simple calculate real net cash flows and discount them using real cost of capital. One thing. Second, the next point is, but there may be the case, which is case two, that real specific inflation and general inflation is different. Yes, they're not the same. General inflation is 6%, just like that. We discussed. General inflation is 6%, others are different. And they say calculate NPV using real approach. Then what do we do? What do we do? So step one, calculate net pre-tax nominal cash flows using specific inflation rate. Pre-tax cash flows, sales minus costs, and sales and costs will be inflated using specific inflation rate each. Second, discount the cash flows using general inflation as discount rate to get real cash flows. And third, do remaining adjustment and get net real cash flows, which will be discounted using real cost of capital. Simple. Note down. We will practice. These are the methods, basically. Let me try to check whether we can do the question right now to understand it properly. Just a minute, please. I'm opening exam kit. Just 2 minutes, please. I'm sorry. You have to wait a bit. Yes. Very good question from the past paper is here in front of you. Pink company. Calculate the nominal NPV. Calculate the real net present value. Second part is not related to us for the time being. So please read the scenario. Let me send you the book as well. Just a minute here. Yes, here you go. The book is on your way. The kit. Yes. So question number 298. In front of you. We are going to do this question. Calculate the nominal NPV, 8 marks. Real NPV. So we are going to do it. Now. So please. Pink Company is a large listed company on a major stock exchange. On a major stock exchange. It is not being clicked. Just a minute, please. It is not being clicked. Yes. In recent years, the board of Pink has been criticized for the weak corporate governance, and two of the company's non-executive directors have just resigned. A recent story in the financial media has criticized for performance of Pink Company and claims that the company is failing to satisfy the objective of key stakeholders. Pink Company is appraising an investment project which its hope will boost its performance. The project will cost $20 million payable in full at the start of the first year of operations. Yes, the project's life is expected to be 4 years. Forecast sales volume, sales variable cost, and fixed cost are as follows. So sales, variable cost, etc. Selling price and cost information are in current price terms, today's price terms. Before applying selling price inflation of 5%, variable cost inflation of 3.5% per year, and fixed cost inflation of 6% per year. Pink company pays corporation tax of 26%, with the tax liability being settled in the year in which it arises. The company can claim tax allowable depreciation on full initial investment of 20 million on a 25% reducing balance. Now, this is the tax adjustment, which we have not done yet, but I will explain it when I will be doing this question. Don't you worry. The investment project is expected to have zero value at the end of a year. Pink company has invest nominal after-tax cost of capital of 12%, real cost of capital of 8%. The general inflation is expected to be 3.7% per year. Now, so students, the point is, so nominal after-tax cost of it. Now come here. So we will be doing like this. Yes. So this is how we will be solving these questions. So first of all, Pink company. Nominal NPV of the project. So first of all, yes, we need to do is start with working. We need to start with working. Working one. Sales. So first of all, sales unit. One, two, three, four. Sales unit. We will write this. 3-digit round off. That is 300,000. For 10,000. 525,000. 000. So these are the sales units. Okay, selling price. So working one is sales. We need to calculate sales. Just see here. Everyone, please focus. So working one is that of sales. So selling price inflated. We need to calculate. Inflated. Selling price in today's term. They say in the first year it will be 125, then 130, 140. In exam, you can simply copy paste the table. Very easy in exam. 120. So selling price inflation is 5%. You see here. That is equal to this into 1.05. Today's term, So in year 1 times raised to power 1. Simple is that. Because this has to be in the year 1. This price in today's term, but it has to be implemented in year 2. So this into 1.05 raised to power 2. Okay, we can do a very good thing. I have wanted to teach you this. Now the way I prefer is simple raised to power this. Okay, now so once we do this, we can simply apply the formula. This has become a formula. Simple. See, apply the formula. Simple. Raised to power 4. This is clear. This inflated price, selling price, I have calculated. Is that clear? Tell me, please. Yes. You see here, formula is here. Future value. Well, how to calculate present value? Present value is equal to future value into 1 plus r raised to power minus n. Okay. This is the present value formula. Okay. N is the number of year. Future value we need to calculate. So what will be? Present value into 1 plus r raised to power n. Positive n. Raised to power n. Future value we need to calculate. Here future value. Today's value is this. Future value inflated with inflation rate. Raised to power n. Simply. This is present value. Is that clear now? Shamina? Huda? Is it clear? Good. Now, so sales. Welcome. Sales, 3-digit round off. Now, very easily it can be calculated. Simply number of units into selling price. Very easy, very simple. Here you go. And here we are. Sales have been calculated. Now, the next is variable cost. Working to variable cost per unit. In today's term, so in today's terms, okay, it is same every year. Same. So inflated variable cost per unit. So inflation rate is 3.5%. This into 1.035 raised to power Again, number of year. Same. Same we have done. So total variable costs. So it was, yes, total variable cost is equal to this into linking the cell. Here we are. Now, the next point is to variable cost per unit, total variable cost. Now the fixed cost. Things are given in a sequence already. Very easy. So working three. Fixed cost. Inflation, yes. In today's term, that is 3,000, 3,100, 3,200, and 3,000. 6% inflation. Inflated fixed cost. 6%. This into 1.06 raised to power this. So, if there is any confusion, you can ask before I proceed. The next is we already have a nominal cost of capital. General rate of inflation, okay, real cost. This is the next adjustment of taxation. Student, adjustment of taxation. What is it? It is very easy. They say they can claim tax allowable depreciation on the full initial investment of 20 million on a 25% reducing balance basis. Zero scrap value at the end. So here 0, 1. So once again, 1, 2, sorry, 3 and 4. We need to calculate tax saving on capital allowance. That capital allowance is basically, it is the amount of depreciation allowed by tax authorities, which can be charged to reduce taxable profit. And hence, because when taxable profit is reduced, Hence, tax is reduced. So tax is saved. So first of all, we need to calculate what is the capital allowance. Then tax capital allowance. Now, you see here, I repeat my words. Capital allowance is the amount of depreciation which allowed by tax authorities, which you can charge against the taxable profits and reduce taxable profit. Okay. Now, so so WDV, written down value, 20 million. So since we are doing 3-digit round off, so 3-digit round off will continue. All amounts are 3-digit round off above. You can see. Written down value of machinery at the start of year one. Now, capital allowance. In other words, depreciation into 25%. 25% reducing balance basis. 25% reducing balance basis. Now, the next is this minus this equal to this into 25% once again. This is again written on value. Initial value minus capital allowance charged for the year, written on value. Next year start. So next year capital allowance will be 25% of it. Quite logical. I repeat my words third time. Initial total value 25% charge. The next year, the difference of the both will be the written down value. And the next year, capital allowance will be on it. Then this will be repeated net. And this into 25%. It will be net. Now, the last year written down value, zero scrap value. Zero. So actually this minus scrap value, whatever it is, here you go. So capital allowance calculation is clear to everyone? Tell me. Any confusion? Right. Next, let us proceed further. So tax saving on capital allowance. Tax rate is 26% in the same year, in the year in which it arises. This into 26%, same year. So tax saving on capital allowance is here in front of you. If there is any confusion, you can ask me before I proceed. Yes. Right. So we have to proceed now. We have to prepare NPV performer in which we will put all the necessary data. We have done the working. This working has its own specific marks, I'm telling you. So you have not to ignore the working. Working is important to show the calculation that how I have done. It is very much important. Remember that. So, what we will be doing? So, come here. Yes. I need to shift these a bit below. Now, so year 0, 1, 2, 3, and 4. First of all, sales revenue. We will link the cell, this one. Sales. Yes. Less variable cost. Again, equal to this minus this. So variable costs. Less fixed cost. Minus link. These are the operating cash flows. Yes. Operating cash flows. Next, we have to pay tax on operating cash flows. We have to pay tax. 26% in the same year. This minus 26%. Oh, sorry, this into minus. Why it is percent? Equal to this into 0.26. Yes. So equal to this into 0.26. And all are negative figures. All are negative figures. Yes. Tax has to be paid. So after tax cash flows. After tax cash flows. This plus this. If there is any confusion, you can ask. Now, student, investment amount 20 million. Investment amount is 20 million. Investment amount is 20 million. Negative. Yes. Scrap value is 0 at the end. Then is tax saving on capital allowance. That will be adjust saving positive cash flow. Tax saving on capital allowance. Net cash flows. Now, from this to this. Net cash flows. Now, student, discount rate, nominal rate is 12%. These are nominal cash flows. So present value at the rate of 12% minus. No, it is present value being calculated. This formula will be applied. This one. You see, present value is equal to future value into 1 plus r raised for minus n. So NPV will be equal to sum of all. And 3-digit round off. Just a minute. Yes, students. Any confusion, any question? So far. It should be around, there is some, oh my God, there is an issue. What is the issue? I have figured out. You see here, I was trying to figure out there is an issue. The issue is here. This is 3,000. Okay. It is basically 3180. And just a minute, please. This is three. We have multiplied it with 125. And so it should be 3 million. That is mistake. 3 million. Now it's okay. I was figuring out what is the issue. So basically, these units are 300,000. Okay. So we multiplied the whole units with it. So we did not do rounding off. This rounding off is only for fixed cost here. Either we have to do rounding off of all amounts or not to do for all. We have to choose one way. So 300,000, 3 million, 3.1 million, it should be. Now it is good. So NPV, yes, so 14. So tax is here. Yes. So let us proceed further. Now the next is real cash method. Real method. So in the real method, there is only one difference. I will solve it here in front of you. Real method of NPV calculation. What is that? We have to simply take before tax nominal cash flows. From here, this one, operating cash flows. Simple is that. Yes. Before tax, operating cash flows we need to take. And then afterwards, what we need to do? We have to pay tax on that, which is, no, not tax. We have to convert them into real cash flows. So real method is the same. We discussed. So calculate when specific inflation is different. Real method, calculate net pre-tax nominal cash flows. It is already calculated. Now discount them with general inflation. The general inflation rate is given here. General inflation rate is 3.7%. So we have to discount them. So real pre-tax cash flows, discounting at general inflation, 3.7%. Simple as that. Into 1.037 raised to power minus. Here we go. Now, so discounted. Now the real cash flows. Now we have to pay them, pay the tax on them. So tax payment, 26%. Minus 26% into this. So tax payment is done. Next, tax saving on capital allowance is the same. We calculated there. Yes, it is the same. Tax saving on capital allowance. It will be added. It will be added. So now, then is net cash flows. Oh, sorry. Here we have to initial investment. That is minus 20 million. Yes. Minus 20 million. Yes. And here in the zero. So net cash flows. So net cash flows are here. Now present value at the rate of, what is the rate? Real 8%. Equal to this into 1.08 raised to power minus this. Yes. And NPV, that is equal to sum of it. So this is the real method NPV. And this is the nominal method. I will share this document with you. I will upload with the lecture recording. Okay, don't you worry. You will have the access of this. You will have the access of it. Okay, this solution. Now, so this is the nominal NPV. If there is any confusion, you can ask. We have calculated the both. Done. Any point you want me to re-explain, please ask. Once again, I will be giving you a quick overview. The quick overview is here in front of you of it. That we inflated all the cash flows with the relevant inflation rates. We calculated tax saving on capital allowance by putting the full amount. Because when you do rounding off, you have to do rounding off all or not. If you choose not to do rounding off, this is actually creates problem just like it created for us today. Okay. Even I wrote 20,000 here as well, which I corrected later on, 20 billion. Then put simple figures here. Sales minus cost, operating or taxable cash flows. You can write taxable cash flows as well. So net of it. Then tax on operating cash flows. Simple. Then after tax cash flows. Then tax saving on capital allowance. Simple net cash flow and present value at 12% nominal discount. In the real method, you have to pick before tax nominal cash flows and convert them real pre-tax cash flows and pay tax and do this and solve. That's it. It is done. There should be another similar question, which I will be giving you as home practice. Okay, I'll be giving you that as home practice. Any confusion, anyone so far? Okay, let us proceed further. So the question name is Pink Company. Yes. The next topic is today, that is adjustment of taxation, which we were doing. Yes. Adjustment of taxation, although we have already done it in the practice question. So taxation adjustment on NPV pro forma. Yes. So two side aspect. First of all, cost of capital. And the second is cash flows. Remember, in the cost of capital, we say always use post-tax cost of capital for discounting unless stated otherwise. Unless stated otherwise. Unless stated otherwise. Now, what does it mean? So, post-tax cost of capital, that is equal to pre-tax cost of capital into 1 minus tax rate. For example, pre-tax cost of capital is given without adjustment of tax, that is 12%. Tax rate is 40%. Now, what is the post-tax cost of capital? It is equal to pre-tax cost of capital into 1 minus tax rate, 7.2%. 7.2%. So the next point is cash flows. Adjustment on the cash flows. Two adjustments on the cash flows. One, which both we have learned with practice. The one, tax payment on taxable cash flows. That you calculate sales minus costs and you pay tax on that. That is sales minus costs. That is the taxable cash flow into tax rate. That is the tax payment. And tax payment can be in the same year or in arrears. Means for year one, tax may be paid in year two, and so on. Whatever examiner says, we have to follow that. Second adjustment. Second adjustment is that is tax saving on capital allowance. Capital allowance. That you have to calculate capital allowance for each year. First of all, and then multiply tax rate with that to get tax saving. Simple is that. And very important point, tax saving will occur as per tax payment pattern. What does it mean? If tax is in the same year, tax payment here, so tax saving will be in the same year. If tax payment is in arrear, tax saving will also be in arrears. Now, it is done. So, students, the next topic for today, that is adjustment of working capital. Normally, sometime it happens. Whenever you launch a project, you have to invest in stock, in raw material. Some cash is to be available. Okay. So some receivable will be there. Possibility is there. So working capital investment is in line with requirement will be there in line with the whatever so examiner says, we have to follow up that. We have to follow up that. So, and all working capital invested during the year, outflow means will be recovered in the last year of project's life. Remember that. So let us proceed further. Any confusion you can ask. So students, let us do another question from the exam kit about, yes, NPV and IRR. Yes, very good question. The question name is Mel Plash Company, June 2022. For the proposed investment in new motorcycle, calculate the following: IRR, NPV, IRR, payback, ROS. And second part is very important. Discuss the suitability of techniques used in A to determine whether to undertake investment and suitability of technique, and advise whether the is acceptable or not. 20 marks. So please read it once. Complete it. I feel like. No. We have time? How much time we have before end of class? Our time is to be ending in we have time, right? Yes, we have. Okay, right. So, students, let us do this. The question name is Melplash Company. Yes. So they say that Melplash Company manufactures motorcycles and is considering an investment in a new high performance model. The market for high performance motorcycle is very competitive, and Mel Plash company's directors want to recover the cost of investment in the model quickly before it is made obsolete by more advanced models at the end of 4 years. The directors have wished to also wish to show shareholders that the investment will be profitable. Directors have therefore set a target payback period of 2 years and target ROAS of 20%. They also have asked the finance director to provide NPV and IRR calculation for the investment. Then plan to consider the results of this calculation if the investment fulfills the target for payback and ROAS. Okay, so we have to calculate these things, NPV, IRR, etc. So very easy. So the production and sale is here. Initial investment, residual value, selling price, right? Inflation, variable cost is inflation, incremental fixed cost, year one price terms. Now you see year one price term, not today's term. Nominal money, ignore taxation. So Mel Plash is a very good question. So we will be starting with again workings. So first of all, the first working is we need to write here sales year 1, 2, 3, and 4. That is 25,000 units. Sales units. 45,000, 40,000, and 20,000. They're the units. And then selling price. In year one terms, 20,000. And then inflated 6%. Inflated by 6% later on in year one terms. It is a different way. So equal to this into 1.06. Equal to this into 1.06. And we can simply drag it as well. Selling price inflation. Inflated by 6%. In the previous question, they had given selling price different for each year. And in today's term, here they have given just year one price and say it after that it will inflate by this. Okay, good, nice. So sales equal to price into units. Here is the sales. Then variable cost. Variable cost per unit. In year one, 14,000. Inflated at 6%. 14,000. 1.06. Yes, same. Now, fixed cost. But we need to calculate, first of all, total variable cost. Number of units into variable cost per unit. Yes. Then will be the fixed cost. 120 million in year one. Remember that. This is the Formula of examiner 120 million, then 10% increase. Here you go. Things are almost sorted out. All the tax has to be ignored, so no tax saving on capital allowance, etc. So simply we will be putting all the figures here in the performer. Yes. So sales year 1, 2, 3, and 4. So first of all, sales. Less variable cost minus variable cost. Then fixed cost. Fixed cost. Here we go. Initial investment. Now there is no net cash flows need to be calculated because no taxation. Okay. For you, pre-tax cash flows. So that you do not, get confused. Okay. Pre-tax cash flows. But there is no taxation. Simple. Initial investment. Anything else? Inflation adjustment? No inflation adjustment. So initial cost is 220 million and 30 million. 30 million residual value. This is residual value. Investment will have this residual value, this. Anything else? Nothing. So simple is that we will calculate net cash flows, and afterwards, when we calculate net cash flows, and we will simply discount it using nominal cost of capital to get NPV. Now, so net cash flows. From this now. So what is the discount rate? The discount rate is nominal 14%. Here's 0. This into 1.14 raised to power minus this. Yes, so NPV is equal to sum from here to here. 16.79 million NPV. The next requirement of the question is that you need to calculate IRR. Very easy to calculate IRR. Remember the formula I have taught you. That is to be utilized in the section A and B of the paper. Here, very easy. You will utilize in the section C simple IRR formula and select all. No. This net cash flows. IRR, this. Simple. Select, enter. 18% IRR. 17.7%. So simple, you will, this is students, this is how it is to be calculated. Next, So the next is the next requirement is payback period. Very easy to calculate. So simple. I will here copy. Yes. So yes, year zero as well. So net cash flows we will take to calculate payback. Net cash flows. Remember, students, wherever you think that you could not get anything, please don't hesitate to ask me. Do ask me. I will be ready to explain it 2, 3, 4 times. Yes, 220,000 and yes, now it's good. Payback period. What we need to do for payback period? Tell me. For payback period, we need to calculate an cumulative cash flow. Last lectures. So negative this recovered, then this recovered. Now this is needed. Part of year 3 will be utilized. 2 year complete. Part of C3 how much? This divided by this. 2.23 years. Yes. 2.23 years. Now, next, ROS, return on capital employed, based on average investment. What do we need for that? We need profits. We have cash flows. So, we need to calculate total profits. First of all, so calculation of ROS. This is payback period. Yes, calculation of ROS. What we need to do? We need to calculate depreciation. How we calculate? Remember? Initial cost minus scrap value. Initial cost is 220 million minus scrap value. This is the depreciation. Scrap value, initial cost minus scrap value. That is the depreciation. Next, total cash flows. What do we need? We need profit. So total cash flows are cash inflows from year 1 to year 4 of project. We need total profit. How to calculate? Remember the formula? Cash flow minus non-cash expense is equal to profit. Profit. So cash flow minus depreciation. Now, average annual profit This divided by number of year. Total profit divided by number of year. Average investment. Initial investment 220 million. Plus scrap value divided by 2. Initial investment plus scrap value divided by 2. So ROS, ARR, average annual profit divided by average investment, 26%, 26.4%. That is the second 26%. Second question we are doing today. So now they say whether it should be accepted or not. In the next part, they say any confusion, any question, please. Next. The next point is, students, one thing we need to deduct from the cash flows. What is that? While calculating profit, we need to deduct from it because here residual value is also included. We missed that. Note down this point. I explained it in the last class that while moving from cash flows to profits, residual value has to be deducted as well. Why? Because that is part of cash flows. And while in the profits, that is not included. So now ROS is 20.4% in front of you. Now, students, discussion. The next part, we have done all the calculation. Now 9 marks discussion is there. Suitability of the technique. So we have to discuss basically the positives and a bit negative for each technique. We have not to discuss in the bullet point, discussion style. For example, we will give NPV heading of NPV, B part. NPV, we will discuss NPV benefits. It is based on profits, cash flows rather than profits. Consider time value of money. It helps to identify the impact on shareholder wealth. But all are the estimates. Now drawbacks as well, but all are the estimates. Okay. So 3-4 points. 2-3 benefits, 1 drawback in 1 paragraph. Then same is for the IRR. Same is for the payback. Same is for the ROS or ARR. So 2-3 benefits, 9 marks. 9 marks means 4 points. Now, so next. Here, now final. So we have to discuss suitability. Advice to Melplash. Advice for final. So these 4 headings. Remember, I am telling you, we have not to write in bullet points, rather discussion paragraphs for each. So advice to Melplash. Now, so we can see they have given us a criteria here. The target ROS is 20%. Payback is 2 years. Target. So target payback, ROS is crossed. But payback is not problem with the payback. As per payback should not be accepted. Now, so Next, the project is acceptable under NPV method as it is positive and IRR is greater than cost of capital. It is greater than 18% IRR, 17.7%, and the cost of capital is 14%. While ROS is also greater than target ROS. So as per these three methods, it is acceptable. While payback period of the project is higher than required payback than the required payback decided by directors. Yes. So considering as a whole picture, directors should go ahead with the project as it is financially viable and will lead to shareholders' wealth wealth. Any confusion, you can ask, please. Students, it is done. The next is we have to discuss capital rationing. Okay, so I will take a 5 minutes break, be back and discuss the capital rationing in 5 minutes time. See you in 5 minutes. Yes, students, now the topic is capital rationing. I will explain my iPad on my iPad. Just a minute. I'm connecting it. Yes. So capital rationing. Capital rationing is the situation where there is limitations of funds. So when there is limitation of funds, funds are limited. Funds are limited. Projects are too many. Positive NPV projects, so many there are available. Positive NPV projects, there are so many available. So we have to do pick and choose. We cannot undertake every good project. We cannot. So capital rationing may be because of two reasons. Reasons of capital rationing. Why? Internal reasons of company or external factors. Internal reason is that we don't want to raise funds ourselves, our own decision. Funds are available in the market. So internal reasons are there. And these internal reasons, internal factors, own decision, they are called soft capital rationing. And it is called a hard capital rationing. Rationing. External. Banks are not giving loan. Government has put restrictions on lending. Market condition is bad. You cannot issue shares. Now, so, I'm sorry. So, capital rationing, here it is. Soft, internal factors, soft. External factors. Management is reluctant because they think that if we issue share to the public, company's ownership will go in the hand of others as well. So current people who are having companies control, they will lose control because now other people will have also shares. Management does not want to issue further shares. Why? The factor is EP, earning per share will reduce. How EPS is calculated? Total profit attributable to shareholders divided by number of shares. If profit is not increasing much, shares are increasing. So EPS will go down. They don't want to raise debt because they say that fixed interest, we don't want to be burdened. Okay. So they have a policy to finance new project from retained earnings only. Retained earnings only. Now, whatever the company has, only that, nothing else. I'm sorry. Next, hard capital rationing. Stock prices, shares we have sold, their prices are not optimal. Their prices are, you know, we think that our share should be priced, for example, at $20, but the market is not giving valuing us properly. Investor is marketing value at $18. So we don't want to issue shares. Market is not giving us our true worth. Next, banks are not lending, government stopped them. Cost of new funds is too high cost, higher interest rates. So now, how to remove hard capital rationing? This situation, joint ventures, big invest with some bigger, similar, some amounts will be invested by us, some will be invested by some other party, the joint venture. Give licenses, do franchising, or venture capital, big investors, go to them. Business angel, rich people sitting at home, sell some assets, get money, sell some building or government grants. So hard capital rationing. No soft capital rationing. Only management has to change their minds. Funds are available. Yes. So the next is types of capital rationing. Students, come here. Types of capital rationing. Now, why we are going to study it? Why? The reason is objective is to find ways and to make optimum or best investment plan. Now, what is the best investment plan? Which has highest NPV? Having highest NPV of projects for company. Best investment plan we need to make. So, come here. So types of capital rationing we are going to talk. That the first type is single period capital rationing. Second is multi-period capital rationing. Single period capital rationing is that capital rationing where funds limitation is for 1 year only. And we have to start the projects now. We cannot delay even. So here, funds limitation is for multiple year. For multiple years. So single period capital rationing, in this case, if projects are available projects, we have to choose from them, are divisible. or available projects are indivisible. Two possibilities further. If available projects are divisible, then we use profitability index to prepare optimum investment plan. We use profitability index. Next, if available, we will be learning this method. Just for the time being, we are going through an overview of the topic. One by one, I have to discuss everything. If they are indivisible by trial and error, form combination of projects within available funds limit and choose the best combination. And choose the best combination. Students, let us proceed further. So, available products are divisible. The purpose is to choose the best investment plan. This is the purpose. Optimum investment plan. Best, having highest NPV. This is the purpose. So if available projects from which we have to choose, they are divisible. Divisible means we can take part of the project. For example, I have 2 million and the project's total investment is 10 million and NPV is 4 million. Okay, I have only 2 million. So I can invest in the 20% of project or not. If I can, it means it is divisible project. If I cannot, I have to take full, that is indivisible. So individual product 20% and 20% of NPV will be then. I will get 0.8 million. That is divisible. Now, the point is in the profitability index, how it is used. So let us, I will be moving towards again. So basically, what we do, see here. For example, available investment that is equal to 10,000. And available projects are A, B, C, D, and E. Projects available. Investment required, that is 4,000. 3,300, 4,700, 2,250, and 19,900. So NPV, for example, NPV is 1,900. NPV is 1,400. NPV is 2,300. NPV is 1,200. And NPV is 950. So now our 10,000. There are so many projects we cannot invest in now. We have to choose the best investment plan. And for example, projects are assumption divisible. Now, V profitability index is equal to NPV over investment. NPV over investment. So we will calculate profitability index, NPV divided by this. So we will calculate profitability index. Yes, 1,900 divided by 4,000. 0.475. 0.424. 0.489. 0.533. 0.5. Now, this is the profitability index. Now, the next we need to do is ranking of the projects. Second is the ranking. Highest profitability index, rank 1. Second highest, rank 2, rank 3, rank 4, and rank 5. Highest profitability index. So, just see here. Now, investment plan. Okay. Available funds, NPV, projects. First choice is D, project D. Available funds are initially 10,000. We know that. 10,000. So project D, investment is 2,250. That is equal to 7,750 available investment remaining. And NPV earned will be 1,200. NPV on it, 1,200. Remaining investment is here. Then project E, 950. Investment, 6,800. And NPV earned is 950. Oh, sorry, my mistake. It is 1,900. Investment is 1,900. So deduct from that, how much it is? 5,850. and 950. Next, D and E gone. Next turn is of 3, ranking 3, C. Investment is 4,700 and NPV earned is 2,300. Double 150. So now fourth is here. We cannot invest in full. We can invest only project A1150. So how much here? So 1150 divided by total investment, percentage of investment into NPV 1900. 546. So this will be the total NPV earned. 546 plus 2300 plus 4996. So the best investment plan, the company should invest in project D, E, and C in full and in project A partially. This is when projects yes. How I got 46? Once again, very good question. In the project A, total investment required is 4,000. We have only how much? 1150. We can invest only 1150. Products are divisible. So we will take 1150 out of 4,000. This percentage we can invest. And the same percentage of its NPV. Same proportion of NPV. NPV is 1900. So we got percentage of investment into percentage of NPV. Got it? Is that clear? Okay, thank you. So this is complete discussion on when projects are divisible. So friends, I think we have done enough today, but I will be giving you some homework, okay, which you need to do, please, at home. So just a minute, I'm going to give you homework. Yes. From the exam kit, you need to solve the question. Question number, it is, the name is Habak, 292, homework. Let me show you. This is the question, Habak, 292. Question 292, Habak company. It's A part you can do. It's A part you can solve. B, of course, we have not discussed yet. Yes, A part. Okay. So that's it for today. We'll be meeting in the next class, and the next class topics are uh, completion of capital rationing, risk and uncertainty, and practice questions. Thank you. God bless you. See you next week. Any question? Yes. Okay. Take care. Goodbye.